Hey everyone, let's talk about investments and specifically about portfolio theory. Now, this is going to build on our prior discussion of modeling asset payoffs, and with that in place, we can actually then measure investor risk tolerance, and using that as a gauge, we can actually create the optimal portfolios based on an investor's risk aversion. This is going to be following Bodie, Kane, and Marcus chapters 6 and 7, and we're going to begin with describing just how we can quantify investor risk and return preferences. Then we're going to talk about how to make investment decisions with just a universe of risky assets or a universe of risky and with one risk-free asset. We're going to talk about how these will actually fall, in that case, on a capital allocation line. In other words, the portfolios will be linear combinations of a risky portfolio and the risk-free one. And finally, we'll talk about how to make sort of the optimal portfolio composition based on investor preferences, and talk about how that leads to the idea of mutual fund separation. In other words, the idea that actually everybody is going to mostly end up holding the same sort of risky portfolio. So let's begin with risk tolerance. So when we wrapped up our discussion of modeling asset payoffs, we figured out how to measure the uncertainty about investment returns using standard deviation and variance. But now that we have that in place, we should ask ourselves, how can we actually use that to evaluate one asset relative to another? And of course, to do that, since we now have these measures of risk in place, we now have to have a measure of preferences over these risks. So that will let us actually capture this idea of a trade-off between risk and return. And that'll allow us to model investor decisions and actually come up with an optimal allocation for an investor based on their risk tolerance. So in a way, this is sort of the fundamental idea that underlies portfolio theory and the idea that we can create an optimal investment for each investor. So how could we quantify or characterize an investor's preferences for risk and return? Well, one commonly used approach is to use a utility function. In other words, it's a function like any other. It'll take some arguments. In this case, it'll take maybe our wealth and the volatility of the wealth, and maybe a measure of somehow how risk averse we actually are about that volatility. And it'll give us sort of a index of just how happy we are. So this might not be like an absolute measure. There's no such thing as happiness units after all, but it'll be a comparable measure. In other words, we can say that even if we don't really know what a unit of utility is, having higher utility should be better than having lower utility. And when we talk about utility functions, we often conceptualize them looking a bit like this: a concave utility function. Now, why is it concave? Well, first of all, we want our utility to be upward sloping in wealth, right? So if we have utility on the vertical and wealth on the horizontal axes, the more wealth we have, just based on observation of people, the more happiness they should have. One seldom hears a person complaining that they have too much wealth after all. So upward sloping is an important characteristic, but another important characteristic is concavity, or sort of a diminishing upward slope. And the reason for that is when you have very little wealth, having $1 extra will make you much happier in general, it seems, than having $1 extra when you already have $1 million. In other words, when your wealth is very large, any additional increment in wealth is going to be a rounding error. It's not going to make you too differently off than you were before. But if you have very little wealth, then having a little bit extra will actually make potentially a big difference. So we want the slopes to actually be higher on the lower end of wealth. So in other words, if you have an extra $1, your utility goes up by a relatively larger amount. Then by the time you get to larger amounts of wealth, where having an extra $1 still probably won't cause your utility to go down, but it just won't cause it to go up by as large an amount anymore. So another way to say it is that your satisfaction or utility from an additional $1 is actually going to be diminishing incrementally. Your marginal utility of the $1 is going to be higher when you have relatively little wealth, and it's going to be lower when you have lower or higher wealth. But of course, it's always going to be positive. So we want marginal utility to be non-negative, but we want it to decrease as wealth increases, just to capture this sort of behavioral idea that by the time an investor has a large amount of wealth, they're not as happy to get any additional extra $1 as they would have been if they had lower wealth. And we can capture both of these characteristics a lot more precisely than just sort of talking about them by using math, and specifically by using calculus. So remember, the first thing we want is for the individual to be happier when they have more wealth. And a way to say that with math is that the slope of the utility function is non-negative. In other words, if we take its first derivative with respect to wealth, it's going to be positive. The more wealth you have, the happier you are. And the second bit that we want to capture with math is that having more wealth at a higher level of wealth won't make you as happy on the margin as it would have if you had lower wealth. In other words, $1 extra is actually making you happier if you have very few dollars than it would if you already have quite a few. And the way to say that with math is that the change in slope, in other words, the second derivative of the utility function, is negative. In other words, the marginal utility of an extra $1 is diminishing. And it's the second feature of the utility function, the fact that the marginal utility is falling, that it's a concave function, is really what is equivalent to the idea of risk aversion. So when we talk about investors having a concave utility function, they have diminishing marginal value of additional wealth. We implicitly then will also require them to be risk averse. We'll see how that actually comes about in just a little bit, but let's first sort of look at some examples of utility functions that satisfy these two criteria: upward positive slope and diminishing positive slope. In other words, positive first derivative, negative second derivative. A common one is a quadratic utility function. So in other words, we have a linear term in wealth, and that's positive, and we have a negative quadratic term in wealth, maybe divided by some coefficient. And you see that actually for this one, we're going to bound wealth to be below some arbitrary level of 60. And the reason that this is because this, of course, is the function of a parabola. And if wealth goes above 60, you'll actually see that it starts to exhibit a characteristic we don't want utility functions to exhibit, which is a negative slope. Negative first derivative, wealth somehow making you less happy, This is a problem we sometimes characterize as having a bliss point. In other words, your optimal wealth is 60, and any more than that somehow makes you less happy. And that doesn't seem realistic, so we would cut the utility function off at wherever the bliss point is. But leaving that aside, let's take the first derivative of this candidate utility function with respect to wealth. We see that then the first derivative is 1 minus w over 60. And while, this is sort of why we introduce this cutoff at 60, we see that while wealth is below 60, 1 minus any number less than 60 over 60 is going to be greater than 0. In other words, our slope will be positive. And in fact, when we get to 60, then 1 minus 60 over 60 is going to be 0. This utility function will now have a flat slope, and that's sort of what's going to cause it to not really be capturing what we want it to be capturing anymore. And then, of course, if we go beyond that, it's in fact going to start having a negative slope, which is even worse. So quadratic utility is not necessarily the best utility function, but it's a good introduction. Now, by the way, what is the second derivative of this? Well, if we take the second derivative of this function, which is equivalent to taking the first derivative of 1 minus w over 60, which is the first derivative. And remember, the second derivative can also be expressed as the derivative of the first derivative. Well, of course, we immediately see that if the first derivative is 1 minus w over 60, a derivative of that with respect to w is going to be negative. So this function does satisfy both of the mathematical characteristics of having a non-negative first derivative and a negative second derivative. But there are many others. So another candidate would be log utility, where our utility of wealth is the log of wealth, and negative exponential utility, where our utility of wealth is negative e to the negative wealth. And if you take the first and second derivatives of these functions, you'll find that they also satisfy these same requirements. So now, what does risk aversion actually mean? Well, a risk-averse individual is somebody who prefers a certain level of wealth, at any level, over a expected risky level of wealth that has the same expected level. In other words, having, let's say, $5 for sure is better for you than taking a bet with an expected payoff of $5. Let's say either 10 or 0. With equal probability. And so to characterize this with math, we would say that the utility function at whatever your level of wealth is going to be greater than the expected utility of wealth over whatever the possibilities actually are. And it's important to note here that even though investors then don't want risk, it doesn't mean that they'll avoid it altogether. They just want to be compensated for taking it. And we can sort of see how this relation will come about if we just revisit the idea of the concave utility function. So remember, a concave utility function has a positive upward slope, and it has a negative second derivative, so the slope is diminishing. So that means that any value on this function is going to be above the expected value of any 2 points. Because it's concave, it's always going to be above the expectation of any 2 possible payoffs on it. And so that is literally what we are capturing with this mathematical statement. The utility of any level of wealth is greater or equal to than the expected utility of any other levels of wealth. Now, being risk-averse introduces also the idea of then a risk or insurance premium. So another way to talk about risk aversion is to say that, all right, we know that the utility of wealth is going to be greater than the expected utility of wealth. Well, then how much can we add to your expected utility of wealth to actually then make you indifferent again? Because remember, we start out with an inequality, but now we're going to add some amount to the right-hand side, and we can just keep adding until that inequality becomes an equality. And that sort of iterative process would effectively let us tease out what the risk premium an investor would actually demand in order to be okay with taking on a risky investment. So put this way, this expression pi c is going to be the extra money you need to induce a risk-averse investor to actually put money into a risky asset. In other words, they would then be indifferent between keeping their money for certain in, let's say, maybe a bank account, and actually putting it at risk, getting some expected utility of possible levels of wealth, higher or lower, but also with this extra compensation for bearing risk on top. And another way to look at the same idea is to actually instead think of the premium as an insurance premium. Because another way to make this inequality of utility of certain wealth and expected utility of risky wealth equal, instead of adding to the right-hand side, we could subtract from the left-hand side. So we could say, all right, how much would we need to take away from the investors' certain wealth such that then they would be indifferent between having their certain wealth minus a certain premium and the expected utility of whatever the risky wealth would be. And of course, this has direct implications for insurance, which is why we call it an insurance premium. And you can sort of see how the risk premium and the insurance premium are very directly tied together. But this way, we're effectively saying, how much would you be willing to give up to get out of dealing with the risk? So let's look at what a certainty equivalent actually means. So let's say we do have a risky gamble that we, for some reason or another, are obligated to take. It could be something like we have an existing portfolio, or we have literally any other situation in life that exposes us to risk. We have maybe a car or a house that can appreciate in value or be damaged and depreciate in value. If we're risk averse, what payoff would actually give us the same utility or happiness or satisfaction as what we would get with the risky payoff? Now, if we know that, that would essentially be the certainty or risk-free equivalent of actually taking on the gamble. So let's see what the gamble might be. Let's say we have initially $40. Let's say we have some asset, and it can either, with probability of 50%, go up by $20 and therefore have a total new value of 60, or with 50% probability go down by $20 and have now a value of only 20. So how much would we be willing to pay to get out of being exposed to this risk? Well, that would essentially mean that we would say that we have now our initial level of wealth of 40, and no matter what happens, good state or bad state, we always will end up with this certainty equivalent. In other words, our risky gamble on the left can be transformed to a riskless position on the right. But then the question is, what is the value of that position? Well, so here's how we can see that having a concave utility function actually makes the investor risk averse. Let's see what the certainty equivalent would be. First, let's see what the expected net payoff from this gamble is. Well, you can see that this is what we call an actuarially fair gamble because you have a 50% chance of gaining $20, you have a 50% chance of losing $20, and therefore your expected payoff is actually 0. And your expected wealth level is, of course, then your initial wealth level of 40. So this is what we would call a fair gamble. Now, the expected utility from this gamble would be, literally as it sort of says on the tin, the expectation of the utility in both possible outcomes of this gamble. So remember, there's two outcomes. One is that our wealth is 60. Another outcome is that our wealth is only 20. Both of them have equal probability, so the expectation is just probability of the outcome times the value of the outcome. And the important thing to keep in mind here is we don't want to make this based on just sort of the net payoffs. We want the total values of wealth, because our utility function is the utility of wealth rather than utility of net payoff. So don't use just the incremental changes, use the total level of wealth. So let's pick some concave utility function. Let's actually go with our quadratic utility that we talked about just a few slides ago. And let's compute what the utility of having a wealth of 60 and a wealth of 20 would be. Remember, this utility function is actually valid for values of wealth up to 60, so we're still okay here. And if we plug in 60, we get a utility of 30 units. Now remember, these utility units are not exactly directly interpretable. There's no such thing as a happiness unit, but they're relatively comparable to each other. Having more utility is definitely better than having less, even if we don't really know what a unit of utility might actually be. So what about our utility of the relatively low level of wealth of 20? Well, again, we plug in 20, we get a utility level of 50 over 3, and our expected utility of wealth, plugging in these utilities of our two possible wealth levels in the two possible outcomes times the probabilities of both outcomes, which are, of course, remember, equal since we assume this is a 50-50 gamble. The expected utility of this wealth is 70 over 3 units. So now the challenge for us to find our certainty equivalent payoff would be to say, well, how much wealth should we then be willing to accept such that our utility of that wealth is equal to the expected utility of risky wealth, equal to 70 over 3. In other words, what does CE have to be to make this equation hold? Remember, our utility of initial wealth is probably going to be greater than our expected utility of wealth. But how much lower would our certain wealth have to be such that the two are then equal? Well, essentially what we're saying then is, what is our utility of wealth? Again, it's this quadratic form. We're going to plug in CE as a unknown variable. And we're going to set that equal to what we know the expected utility of wealth is, 70/3. That gives us with just a bit of rearrangement of moving the 70/3 to the left-hand side of the equation, that's going to give us this quadratic equation right here, which we can then solve using either the quadratic formula or an iterative solver. I encourage you to try it on your end, and you should get 31.72. And this is the certainty equivalent of the gamble. In other words, remember we started with 40, but now we were able to calculate that if we bring our wealth down to 31.72, we are then just as well off in terms of utility as we would be if we were willing to take the gamble of either getting an extra 20 to our initial 40 or losing a 20 from our initial 40 and ending up at either 60 or 20. So this is sort of where this idea of the concave function becomes more clear. Remember, essentially, we've got our concave utility of wealth. We're saying that our utility of 40 is going to be above the expected utility of either 60 or 20. So how much does our utility then have to come down? And in other words, how much do we have to come down in wealth such that we are now the same, that we are equal to what our expected utility of wealth is, which would be somewhere over here? Well, now we've calculated that out, and it looks like we have to come down from 40 to 31.72. So remember, this certain payoff of 31.72 is essentially the equivalent then, in terms of utility, of an uncertain payoff of 40. The expected value, remember, is 40, but it actually can be as high as 60 or as low as 20. And this difference is essentially due to exactly this idea of risk aversion. If you think of it visually, the more concave the utility function is, the bigger the difference between the utility of certain wealth and the expected utility of uncertain wealth. And therefore, to make them equal, we would then take an even lower certainty equivalent. So a higher risk aversion means an even lower equivalent that we would take that's fixed to make the two equal. And then to bring this back to insurance terms, you can actually then think of this as a premium that the investor might be willing to pay to get out of taking this gamble. In other words, remember, you start with a wealth of 40. Therefore, if your certainty equivalent is 31.72, the most you're willing to give up to not deal with this risky gamble of either going to 60 or 20 in wealth is you'd be willing to pay $8.28. And in fact, if you could get away with paying less, that would make you better off. But if you could, this would be as much as you'd be willing to pay before you're completely indifferent between taking the risky gamble and keeping the whatever the certainty equivalent that you have. We can then view the certainty equivalent as essentially a payoff tree, right? So remember, our risky gamble payoff tree is the one we saw earlier. You've got 50-50 chances of going from 40 to either 60 or 20. But now we can characterize our certainty equivalent as another payoff tree also. 50-50 chance, in this case, of getting either 31.72 or 31.72, because remember, this is a certainty equivalent. It's sort of like a risk-free asset. And we can, remember, we won't measure utility on net payoffs, but we can actually calculate the net payoffs for a payoff tree just fine. Remember, our net payoffs would be 50% of the time we gain 20, 50% of the time we lose 20 in the risky gamble. And in the certainty equivalent, we would, in both cases, lose the difference between our initial wealth and the certainty equivalent. In other words, our insurance premium of 8.28. So we can then say that from an investor's perspective, they sort of perceive these two as being equivalent. Either equal chances of going up or going down 20, or 100% chance of losing 828. Those are equivalent in the mind of a risk-averse investor with this particular utility function. Now, we talked about risk neutrality some when we were talking about the expectations hypothesis in fixed income. Remember, a risk-neutral individual is actually somebody who doesn't care about risk. All they care about is expected returns. Of course, that means that their utility function would actually look quite different, right? Because the concave utility function means that the investor is risk-averse. If an investor is risk-neutral, that utility function, of course, won't work. We'd probably just have one that's sort of linear in wealth. And in that case, that individual would not be willing to pay a premium to avoid taking a gamble. And of course, having a higher risk aversion, so being risk averse but being even more so, remember, having a more concave utility function will lead to a lower certainty equivalent, and therefore the willingness to pay a higher insurance premium as the difference between your initial wealth and this lower certainty equivalent. So as an exercise, I encourage you to actually try this example of the risky payoff of plus minus 20 versus a certain loss of the small insurance premium under different utility specifications. So we did quadratic. Try log utility or negative exponential utility. You should get similar results, though the actual certainty equivalent may be different.